What is going on, traders? Exciting show for you guys today, jam-packed, full of information. The S&P 500 sitting at the 200-day moving average. What does this mean? Why I would not short here, even though there could be a bout of market weakness, some more market weakness. I will run you through a bunch of stats, a bunch of data. We're going to go over a lot of the charts, all the information that we have, and try to make the most informed play. But I would not short here. Also, a potential case of manipulation by none other than manipulation Bill himself, Bill Ackman, completely moving the bond market yesterday as the 10-year gets above 5%. Now, I think that the 10-year is going to go higher. And even if you are not a bond investor, you definitely want to pay attention to this. But there also could be a monster bond-related trade as well as bond-related investments. I think right now a traditional 60-40 stock bond portfolio is actually going to do really well and position nicely for the first time in decades. So first of all, let's start with a market update. I'll give you my technical analysis of the S&P 500. Then we will run through those data points and I will tell you why I would not short here, as well as what I expect for the market upcoming. And I definitely want to get into that potential manipulation by Bill Ackman. So, and again, I mean, this is just me accusing him, but he's done it before. Remember, if you remember during the pandemic, and it seems pretty clear to me this time. So we'll get into it. But here's what is in store for the S&P 500, sitting at the 200-day moving average. Why is this important? You guys might say to yourself, hey, Z, I know you don't trade using moving averages. No, but when I'm looking at long-term trends, I definitely look at things like moving averages. I will not take trades based off of them, but I will definitely look at them for long-term trades or long-term trends. Now, I tweeted this out. Make sure you are following me on X and on Instagram for free daily trading and finance content. And I always do giveaways as well. So make sure you follow me on those two platforms. I said the S&P 500 is on the cusp of losing the 200-day moving average. The last 4 times it did this: 2022, which was bear market; 2020, bear market; 2018, we had an almost bear market; 2015, a minus 14% correction. The S&P 500 is currently down about 11% from all-time highs. From the recent rally, when we saw the highs back in July, the S&P 500 is actually down almost 8%. Now, if you guys have been following this channel, you know that I said we will likely get somewhere between a 5 to 10% correction. To me, that would be extremely normal, even if the S&P 500 briefly fell below here. However, if it closes below, significantly below the 200-day moving average and stays below there, history doesn't bode well. But as you guys know, it's also very rare to go from a bear market to a bull market back to a bear market within the same year. Actually, that's never happened. If we take a look at the volume profile and just go back to the all-time highs in January, you'll see that most of the volume for the S&P 500 is around that 4,100 level. And so if we fell to that level, I would be a major buyer in the S&P 500. I do think you can nibble now in terms of dollar cost averaging, but I'd be a major buyer in the S&P 500. Now, if you watched my last video on what is the current problem that the stock market has, you'll know that if we remove Apple, Tesla, Google, Meta, Nvidia, Microsoft, and Amazon, the Magnificent Seven, you'll see that the S&P 500 is actually down on the year. It is not up on the year, right? So the S&P 500 minus or including those companies is up around 10% on the year, a little over. If you remove those 7 companies, the S&P 500 is actually down 17%. That's really ugly. This means that the breadth of the S&P 500 is terrible. There are way more declining stocks in the S&P 500 than there are advancing stocks in the S&P 500. Now let's take a look at this. Speaking of breadth, you could see here stock price breadth. This is one of the reasons that I'm saying do not short the S&P 500 right now. If you are already short and you took a short position from higher up, just like we did, we actually opened up our short in August and we also had one in September. By the way, if you want access to all of our trades, make sure that you click the link below. check out the link in the description. Check out the promo code. You definitely want to take advantage of that. You will get access to all of my real-time day trades, my swing trades, my hedges, my shorts, my longs, etc. Make sure you click the link in the description. Plus, we go live for market open every single week. So if you were already short, that's fine. But opening a short right here at the pivotal 200-day moving average, right above this huge volume profile zone at 4,100, right when the stock market breadth is showing extreme fear, this is not when you want to short, right? Now, if you look at the stock market breadth and we dive into it further, every time that it gets into this territory, if you look at October 2022, that was the bottom of the bear market. If you look at March, April 2023, that was when we had another bounce, right? You don't want to short the market when market breadth is this low. Here's what people are not taking into account, all the analysis that I see online, right? I've seen this analysis before where someone will have similar analysis to me saying the S&P 500 minus the 7 stocks is actually down for the year. It's down 17%. That shows you how shit the S&P 500 is. So these 7 stocks are the only things that are holding up the market. So the market is actually going to tank. Well, that's not really the only conclusion that you can derive from here. If you look at stock market breadth, when the breadth is the worst, what can actually happen is if these 7 companies can justify their valuations, and most of them are going to be reporting earnings soon, right? If they can justify their valuations, who is to say that the rest of the stock market that's actually beaten up, right? All of the stocks in the S&P 500 that are not these 7 stocks are beaten up. Who's to say that those stocks cannot then rally and then the entire stock market lifts up, right? Who's to say that that can't happen? Like, why is the conclusion, the only conclusion that I'm seeing is that these stocks, these magnificent 7 stocks, are overvalued and they're actually going to tank and the market is going to tank further? That's not the only conclusion. Look at stock market breadth every time it is at these levels. The market actually bottoms out. And what tends to happen is that the rest of the stock market will end up catching up to the Magnificent 7, right? So if you look at, if we take a look at the daily chart, you will see that this actually happened back in that March, April timeframe that I was talking about right here, right? Where we saw market breadth low. You could see that the entire stock market minus the Magnificent 7 actually rallied. Same thing back in October 2022. We don't see that the market crashing further when market breadth is this bad. You actually see the rest of the stock market moving up to catch up to the Magnificent 7. Now, obviously, the rest of the stock market ended up declining once again, but we are back to this same place where breadth is terrible. And we are in extreme fear territory, right? And what did Warren Buffett say? He said, be greedy when others are fearful, meaning you do not want to short during times of extreme fear. That is actually when you want to start accumulating. Now, I'm not saying go out and buy these overvalued tech stocks, although there's a couple that I think are okay. But as I mentioned in my last video, there are likely some really nice blue chip value stocks that are actually beaten up right now. So that is my short-term thesis on the stock market. Not so much that we're going to see an epic rally, but that this is not an optimal short. Obviously, I'm not Nostradamus as it relates to earnings. So earnings can be terrible. Stocks can drop to this zone before finding support, in which case I'll be a heavy buyer, or earnings can come out amazing and we can get a rally towards the end of the year. You might be saying to yourself, well, what is going to happen on FOMC on November 1st? What happens if Jerome Powell raises? I don't think he's going to raise. There is one potential reason why he would raise, which I'll get into, but I don't think he's going to raise. Look at what the bets are for the Fed funds futures. The bets are actually that the Fed is going to pause. 97% likely the Fed is going to pause. Why? Because the 10-year and yields in general are going out of control. They're getting out of control for a lot of reasons. So what I think the Fed is going to do is they're actually going to hold here, and they're going to hold here higher for longer. The Fed rate is actually higher now than it was in 2007, right before the crash, which is hilarious. But I think that they're just going to hold here, and they will likely keep it higher for longer and, let the system play out and let the rate hikes actually mete out what they are intended to do, which is to slow down the economy. Right now, if we look at the GDP, we have GDP this week as well. For Q3, GDP might come in close to 5%, which is absolutely crazy. And this is where I think the Fed is going to get spooked. If the Fed, they probably have these preliminary estimates already. But if the Fed, if GDP comes in near 5%, I think the Fed might get spooked. But I still think that they will hold in November. Maybe on December 13th, they might decide to raise, right? Because this is extremely lagging information, and they might have further information that shows the economy is actually slowing from this. But GDP may come in, at 5% or just shy of. Now, I do think that the 10-year is actually going to bounce from here, and I am going to have a play in the Discord probably surrounding the 10-year yield, right? I do think that the 10-year is actually going to bounce from here and will go back above 5%. There's a reason that it tanked here, and it has to do with that Bill Ackman manipulation, which I'll talk about in a second. But I do think the 10-year is actually going to bounce from here, and we will get to above 5. And the reason I think that is because the yield curve has to uninvert, which it is very close to doing. This is the closest to uninverting that we've had since over a year ago, right? So we've gotten to minus 0.12, and 0 would be flat, above 0 would be uninverted. However, if the Fed is not dropping rates, if they're not going to be cutting rates, and I don't think they will anytime soon, probably until Q2 of next year, unless something completely breaks. But if the Fed is not cutting rates, which affects the short end of the curve, remember this is the 10-year minus the 2-year. So if the Fed cuts, then the 2-year drops, and the 10-year will increase in relation to the 2-year, right? And then you might see this flatten out and then maybe even go positive. But if the Fed is not cutting, how is this yield curve going to uninvert? Well, it's going to uninvert by the 10-year yield having to continue going up, right? And I think that that's what's going to happen. Plus, we know that the Treasury is ramping up their debt issuance, meaning they're issuing more Treasuries. And they did this right after the debt ceiling was alleviated. They then started going ham on issuing treasuries. And if you look here, you could see that in terms of the bills, the T-bills, you could see how much the Treasury is actually issuing new treasuries. And the reason they do that is to cover government spending, right? Because they're spending like crazy. They need to find the money. There's only 2 places that the Treasury gets money. 1 is from taxes. 2 is from issuing treasuries. So they have to issue more treasuries. More treasuries on the market means that the treasury prices are going to go down, because once you flood the market with anything, you oversupply the market. That means prices go down. When treasury prices go down, remember there's an inverse relationship between prices and yields. So as prices go down, yields are likely going to fly. Plus, we take a look at the Fed's balance sheet. As the Fed rolls off assets off the balance sheet, over $1 trillion have been rolled off, and they're not buying any new ones. That is also going to oversupply the market with treasuries, right? Contributing to that oversupply. Now, if you remember, Bill Ackman, or you might not have known, Bill Ackman actually shorted treasuries. Now, by shorting treasuries, remember that treasuries, the yields and the prices are inverse. So he was betting that the yields would go up, which they did, meaning that you short treasuries, right? And he had a huge bet on treasuries. Now, I want you to watch this and take a listen as to what happened yesterday and why we saw the treasury market rally and treasury yields drop, right? We saw this epic drop in the 10-year. Over the last couple of days, the 10-year has actually dropped by 3.6%, which is a huge move for treasuries. So let's see what CNBC has to say
today. So we worked up this chart, which shows you the time that he tweeted that he covered his long bond short, which he's had on for a long period of time. So we're showing you that now. Over on that other side of your screen, right? So, Dow's down by more than 200 points. Ackman tweets that, and at basically the same exact time, you had yields start to come down, and then stocks do the exact opposite, which went up. Now, the Dow right now is up 24 or so points. It appears that's what happened. He says, quote, "There's too much risk in the world to remain short bonds at current long-term rates." The implication being all that risk means people are going to end up buying treasuries, and that's going to force rates lower. What do you think?
I think it's a great trade by Bill. I think it's an excellent trade.
Time to cover, you mean?
I think
that short?
No, I think the fact that Bill consistently throughout the third quarter was messaging to markets that he was short treasuries. He sat with you at delivering alpha and basically doubled down on that position.
So he was, if you heard what he said there, he was signaling to the markets. He uses CNBC as his mouthpiece. I mean, you guys remember that. He was saying that Marriott or Hilton or whatever is going to zero, and he then just started buying up all the hotels after that happened. If you remember Rick Santelli, what did he go? This was 3 weeks ago. While Bill Ackman's short was on, this is how Rick Santelli spooked the bond market. Listen to what he said.
So if somebody asked me and held a gun to my head and said, listen, the worst case scenario, where Treasury rate's going to go 10-year. I'd say in the next 7 years, you should be able to see 13.5%, 14%. Yes. Now, I'm not saying we get there, but
he said that the 10-year could get up to 13, 14%. Now, after he did that, then yields actually skyrocketed, right? Because obviously people that are holding treasuries are panic selling their treasuries, and yields started skyrocketing. Right? So do not underestimate these people's propensity to use CNBC as their mouthpiece. So Bill Ackman shorts treasuries, goes on CNBC multiple times, calls in, appears, whatever, says that he short treasuries, tweets it out. They show it, on their TV screens. And then Rick Santelli comes in for him and pushes yields even higher by saying that the 10-year can go to 13, 14% or whatever he just said there. And then Bill Ackman comes out and covers his short, and completely when he covered his short, as you saw there, the minute by minute tweet tracker, he actually crashed yields for a couple of days, and the market rallied because of it. So it's crazy how much power and sway these guys have just by using CNBC as their mouthpiece. So I don't think that this dip in yields is it. I do think that you can actually go short yields once again. I will likely use the ZN futures for the 10-year. Remember, ZTs for the 2-year. You guys have seen me put that trade on. I will likely use ZN for the 10-year and potentially go long the 10-year treasury yields here to get back above 5%, because I think that's what's going to happen when the Fed pauses and this economic data comes in and it's actually good. GDP comes in higher. I don't think that companies are going to miss earnings all across the board. I actually think the tech companies will likely, for the most part, make it on earnings. Like, they will meet earnings. It might not be amazing guidance for those that give guidance, but I do think that they will meet earnings. We will likely see the stock market trade sideways or continue to climb. I don't know that it's actually going to crash, barring a black swan event. I don't know that the market actually crashes that drastically. But I think we then we'll probably see yields continue to go up until the Fed comes in December 13th, and maybe they've had enough. Maybe they do one more quarter basis point raise. I don't know. But I do think the 10-year is going back above 5%. Now, in terms of stocks I'm buying, you guys that are part of the Discord know that I started buying Tesla here. Tesla at the 200-day moving average. Also completing a fractal of exactly what happened back in March after earnings, where it was on an uptrend, and then something happened on earnings that was unfavorable, and then it completely crashed, and now is starting to bottom out. I do think Tesla, it actually hit 203 yesterday, which was a steal. So sold cash secure puts on Tesla as well as bought Tesla. You can see my Tesla position here up 45% on those Tesla cash secure puts already. So to me, easy money. I would take assignment or the money. Either or works for me. GLD, I put my money where my mouth is. Beginning of October, I bought GLD, and now GLD is absolutely ripping, almost touching 190. I do think we'll get above 190, but I bought GLD and I also bought some gold when I was in Dubai. So I bought some gold bars, I bought some gold jewelry, and then absolutely crushing it on Tesla. We did a cover call strategy on Tesla. I outlined that in a video. Check that video out here. But collected $1,400 off that covered call, which made up for the loss in NAV value in Tesla. So we're going to collect the 60% dividend on Tesla, while also making up for any losses that Tesla has from drops of Tesla. So closed that cover call out, made $1,400 in that call, made up for the $1,400 loss in the shares, which is now back up. And we are going to collect that 60% dividend. So collecting that dividend almost for free. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a thumbs up. Like I said, I would not short the S&P 500 here. Do not be surprised to see a year-end rally if rates are good, if the Fed actually pauses. Do not be surprised to see a year-end rally. Will we get back to all-time highs? I don't know. We could just get back to the July highs. I am pricing in a recession for next year. I do think that next year we will see a recession, the extent of which nobody knows. This is unprecedented territory. From 2009 until 2020, that was the age of easy money, of quantitative easing. We've never seen that before. So unwinding from that age, nobody can tell you, right? Nobody can tell you what the extent of that will look like. So that is my thesis. Continue to buy good companies and blue chip stocks, blue chip indices on major discounts. A lot of you were telling me you're crazy for buying Tesla at 203. It's going to go to 48 or whatever. Come on, guys. Come on. That when you're investing, look for companies that you want to own at major discounts. That's all you need to worry about. Sign up if you want access to the Traveling Trader Academy. Make sure you don't miss out on the cover calls, the cash secure puts, the day trades, the swing trades, the long-term stocks that I'm buying, tutorials on how to day trade, how to position yourself in treasuries, etc., whatever, right? We have 3 full-time analysts, including myself. Make sure you take advantage of that promo code in the description below. So sign up. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.